What is a 401k loan and how do I get one? How do I pay it back and should I get one? Well, in this video, I'll go over the answers to those questions, and if you stay to the very end, I'll tell you 3 times when I think it's an okay idea to take that 401k loan. Coming up. Aloha everyone, my name is Matt Ragudo and I'm a chartered retirement planning counselor. And what I do on this channel is I give information and resources on retirement planning so that you can work toward your ideal retirement and get rid of uncertainty. So if that interests you, consider subscribing. Let's get into it. Before we do start, I must say that I am a financial professional, but all the information gathered here for this video today is for informational and educational purposes only. Always consult your individual investment, tax, accounting, and legal advisors before initiating any transactions. And with that said, let's get into it. What is a 401k loan? Well, it's just that. It is a loan against your retirement account at work. Now 401k, 403bs, 457s all have the same plan language that will allow you to actually loan out a certain percentage of your account value, and it's up to 50% or $50,000, whichever is lower. So if your account balance is $25,000, you could only take out 12.5k or $12,500 from your account. So how do you get one of these loans? Well, simply go to your plan sponsor, whoever is your 401k administrator. Could be Fidelity, could be Schwab. Go to them or your HR director and they can point you in the right direction and get the paperwork for taking out a loan. So part 2 of the video, how do I pay back my loan? Well, for the 401k loans, typical payback period is going to be 5 years. And you're going to have to pay back that via payroll deduction. So similarly how you were putting money into your 401k, in this instance you'd be putting money towards the payback of that loan, and you have to make that complete repayment within 5 years unless you use that money from the loan to pay for a principal primary residence. Then you have up to 25 years. Very, very important tip, and actually not a tip, but you better know this. If you do have a loan and you leave the employer that you have that 401k with, you are required to pay back that loan in 60 days. So you have an accelerated payback period of 60 days. Times like those, you may want to consider actually taking out a loan from somewhere else versus having it count as a withdrawal, because under most circumstances, unless you qualify for a hardship withdrawal, I have a video about that. If you qualify for the hardship withdrawal, you don't have to worry. But if you don't, you're going to have to pay taxes on the distribution of your gross income level plus a 10% penalty. And for some people, that could mean a government check that you have to write to the IRS for 45 to 50% of that loan amount. All right, part 3. What happens to that money that I loan out of my 401k? Well, basically what happens is, let's say you are invested in 4 different funds and you have a $100,000 401k balance and you want to loan out the maximum, $50,000. So from those 4 investment funds, 50% of each will be taken out to make that $50,000 loan amount, and it will be held in a separate kind of contract where it would be a $50,000 account balance and a $50,000 loan balance. And what the market, overall effect of the 401k will only pertain to the money that is left, or the money that's not contingent to the loan. To make things simple, all the money that's taken out in the loan is effectively removed from the stock market or from whatever funds your 401k invest your money in. So with the payback period and the loss of being able to be participating in market returns, which is pretty much the reason of a 401k, why would you take a loan? Well, a loan is just that. It is a loan. So one of the pros of having a loan versus a withdrawal is no tax. When you take a loan from your 401k, so long as you abide by those rules we spoke of, you don't have to pay taxes. So essentially, you could have a $50,000 inflow of cash without paying any taxes on it. Now, you do have to pay that back, but if you were to compare, what's better, a 401k withdrawal or a 401k loan? That is one of the pros of having the loan option on your 401k. Another benefit of the 401k loan is that it does not affect your credit score at all. So if you have bad credit or you want to work on your credit and don't want another loan on your credit report, the 401k loan will not even touch your credit score. So when is it a good time to use the 401k loan feature? And many people actually use the 401k loan feature for things like student loan debt, paying for kids' college, maybe potentially the first house. I would say that those are very noble purchases. But for the 401k loan option, because of all the downfalls of potentially if you lose your job or have to switch employer, you have 60 days to repay it back, or you get hit with the penalties plus the gross distribution taxes on it. And for paying for college, that's very important, but potentially there's other ways to go and get it, because again, this is your retirement we're talking about. Your child can go and work for their own retirement and not sabotage your own. So what are the three main reasons why it's okay, maybe, to take out a 401k loan? Well, the first one would be if it is to pay for high deductible health plans deductible phase. So a lot of us have to buy what's called high deductible health plans, meaning we have a $7,000 deductible, quite high. Most times we can get away with that by having an HSA or having money set aside for this known medical cost. But if you don't for some reason, that is one time where taking that loan from the 401k might be a viable option. Also, it would qualify for a hardship withdrawal if it exceeds 10% of your AGI. So you could technically convert it and then put it towards your medical bills and have the penalty part waived. The next reason would be if you are strapped for cash and you have an immediate cash need but have bad credit. Then maybe, this is a big maybe, if you've exhausted all other methods and you can't get a loan for under 10%, utilize a small portion of your 401k for a loan. And potentially, if it's an immediate and heavy financial need, it may also qualify as a withdrawal. So having that option may be beneficial. And the last one, it's very risky. You have to have a plan for this, but if you are intending on utilizing a loan to pay down a higher interest credit card debt, that may be an option. Now, in future videos, I'll go over on how to tackle the debt problem, but for now, if you have a debt strategy, meaning you know how much you're going to allocate toward your debt per month on a consistent basis, then potentially taking that 401k loan would be a good option to lower your overall interest rate on the high interest credit cards. And realistically, it's like consolidating your loans, but you have to remember to pay back the 401k loan. I hope the information today helped you make some choices on the 401k, learn a little bit about the loan feature, and make decisions that benefit your ideal retirement. For more videos like this, be sure to subscribe and like the video if you did enjoy it, and share it with a friend. Well, I hope that helps. We are here in case you need any more questions answered, and we'll see you in the next one.